I'm Jeanne Kane, a certified financial planner with OneDigital. One of the questions that I get asked all the time during a presidential election year is, how will the election affect the markets? Well, there have been 24 presidential election years since 1926. And of those years, the stock market has had 20 positive years and 4 negative ones. The average S&P 500 return during those 24 election years was 11.6%, with the best return coming in 1928 and the worst return coming during the global financial crisis of 2008. Now let's look at the results from the perspective of which political party won the election. 3 of the 4 negative years were when Democrats won the election. So it would seem that when Republicans are elected, there's a better rate of return. But wait a minute. Are we going to blame the Democrats alone for inheriting situations like the global financial crisis in 2008? A Republican president was in power prior to 2008. Let's take it one step further and look at all the returns for all of the non-election years. The average rate of return was 12.4%. Now this time, the highest return was when a Democrat was in office, and the lowest return was when a Republican was. The point here is that the political party in the White House doesn't dictate what's going to happen in the stock market. And if you look over the history of the stock market, you can see that the value of a dollar has increased regardless of who was in the White House. Markets care more about what's going on around the world, with the economy, with inflation, and the policies that affect them. Those larger economic factors have a big influence on the markets, not just the US presidential election. And in a nutshell, financial markets care more about policies and not politics. And if you're interested in more information regarding this topic, I'm happy to discuss it with you one-on-one. Thank you.